Hello and welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Olivia Grace-Curran. US stocks ended Wednesday little changed, with investors digesting the impact of two conflicting sets of jobs data and a report that said President-elect Donald Trump was mulling a national economic emergency declaration on inflation. Major indexes fluctuated between slight gains and losses, ending in mixed territory. Mega caps were mixed, with Microsoft up, while Alphabet and Meta fell. Shares of Edison International were down as wildfires rage out of control near Los Angeles, on track for their biggest one-day percentage drop since the COVID pandemic in March 2020. eBay shares jumped, touching 52-week highs, after the company announced that Meta is testing using its listings on Facebook Marketplace. Shares of Johnson & Johnson slipped after the drug and medical device maker said it has temporarily paused the rollout of a heart device in the US as the company investigates 4 reported stroke events. Arcadium Lithium stocks rose after the company received clearance from the Committee of Foreign Investment for the proposed acquisition of ALTM by Australia's Rio Tinto. Chocolate maker Hershey's shares pushed lower. On a report, the company is asking the US top derivatives regulator for permission to buy a huge amount of cocoa through the New York Exchange as prices hit record high. And quantum computing stocks tanked following Nvidia CEO Jensen Huang's comments that quantum computers are years away. Federal Reserve officials at their December meeting expressed concern about inflation and the impact of President-elect Donald Trump's policies. Minutes released on Wednesday detailed the board's discussions about the effect that changes in immigration and trade policy could have on the economy. Documents showed almost all participants judged that upside risks to the inflation outlook had increased. Members indicated the pace of cuts ahead is likely to be slower, but stressed future policy moves will be dependent on how the data unfolds. Meanwhile, Federal Reserve Governor Christopher Waller, speaking in Paris on Wednesday, said he expects the central bank to lower interest rates further this year, even though progress on inflation, quote, appears to have stalled. Waller said he sees signs inflation is easing and will continue to do so. The 10-year Treasury yield, underpinning trillions of dollars in daily global transactions, jumped to above 4.7%, its highest level since April 2024. The sell-off in bonds accelerating after reports US President-elect Donald Trump is considering declaring a national economic emergency to impose tariffs. 2-year note yields were down 1 basis point at 4.28%. The bond market sell-off unleashed a fresh wave of selling in currencies against the greenback, the Canadian dollar edging lower as Treasury yields climbed and investors grew concerned about the threat of American trade tariffs. The pound slid more than 1% before slightly recovering, while the US dollar rose. And Bitcoin has slipped further, now around $95,000 US. Oil prices fell more than 1% as a stronger dollar and large builds in US fuel inventories last week pressured prices, reversing earlier gains from the tightening supplies from Russia and other OPEC members. Brent crude was down 1% at 76.23 US a barrel. Iron ore futures declined for a 4th straight session on Wednesday, weighed down by weakening steel demand and an increase in port arrival volumes in top consumer China. While gold prices hit a near 4-week high after a weaker than expected private employment report for December provided reassurance for some in the market that the US Fed may be less cautious about easing rates this year. Spot gold rose 0.3% to $2,657 per ounce. For more on what's moving markets, Ira Epstein from Linn Associates joins me now. Good morning. Now, overnight we saw a global sell-off in bonds, and that pushed US stocks down.
To a degree. What's really been going on is we've been seeing this. Let's understand where we're at, and Happy New Year to all. It's a new year. In the United States, we haven't had one full week break yet since Christmas. So we missed it before Christmas. We then missed it the week of New Year's. And now tomorrow, the stock markets are closed. The futures markets have partial days open. So what's been going on is a rebalancing. You get this at the beginning of each year. There are some ominous signs that happen. For those of you that watch the Santa rally, and I'm one of them, it's had a pretty good track record. It didn't work this year. And if you go by the first 5 trading days of the year to give you an idea, is the market going to be good, bad, and different? They certainly haven't done very well. They were up in the S&P, but not so in the Dow. So some of the telltale signs from that is there. Then you look why. U.S. interest rates continue to climb. They're not climbing because people are running here for safety. They're climbing because the U.S. economy is so strong. We have a labor market that refuses to break down. We have inflation that is still high. The president can declare all he wants on his war on deflation. How do you stop it? Well, it's pretty simple how you stop it. Number one, if the government would stop spending large amounts of money and go back into what we call real fiduciary tightening, that's one way to stop it. But will they? Do they have the wherewithal to do it? We'll find out. The Trump administration is going to be unique in that he's a one-term president this time around. He's really a second-term president because he took a break or he was forced into a break, either way you want to cut it. Therefore, his legacy is going to be made in 4 years, and he's going to hit the ground running. Every time he threatens, it's another way of saying, listen, you either, so to speak, follow the lead we're giving you, or there's a price to pay. How long it can get away with that, no one knows. But given the strength of our economy against all economies, and I'm talking economics speaking, there's a real problem. You go to Asia, China reminds me today of Japan a couple of decades ago. I didn't mean days, decades. And they're in a spiral down. And what they're trying to do to support the economy, to me, isn't going to work. Now they're giving you rebates on toasters, dishwashers, cars. That isn't the way to do it. You've got to expand your markets abroad. You need foreign money coming in. They're turning very much inward, which means the government subsidizes the companies, then it subsidizes the individual to buy the goods from the companies, and it keeps going in a circle where you don't go anywhere. That's what I'm seeing right now.
And Ira, what are you taking from the Federal Reserve minutes that came out?
There's a fight within them. Leaders will go this way. There's a history at the Federal Reserve that you don't fight with the chair. The chair has wanted to do what he wants to do, but when you read it, there's dissension galore. I think that members wish they could take back that vote to cut the rate in December. I think they did it as a, let's call it a gift, as a Hail Mary, that the idea that inflation would fall, give it time, and we're not seeing that at this point. So the Fed's caught in a rock and a hard place. They need inflation to fall via keeping rates very high and restrictive, and what they're hoping for isn't their action. They're hoping that the marketplace does their job for them. By going up near 5%, in a 30-year bond, which had a very good auction today. We saw today, I think, the 20 years and 30 years go in this week. And now we're seeing that the short-term money getting up, for example, in the 10-year to the rates that's pushing 5, it's the same thing. You get these rates to this point, and the Fed doesn't have to raise rates. The market is doing it. So it's going to take time. And that time is one in which the Fed can't go up in rates. It has to cut. If it goes back up in rates, you've done what the Fed chair, Powell, said he never wanted to be in the position of doing, following Volcker. When Volcker cut rates and then had to come in and change everything about it. He doesn't want to go that rate. So we're going to stay as we are. But I don't think you have another rate cut coming in America till late summer based on current information. If that changes, I'll change with it.
Interesting. And Ira, it's just under 2 weeks until Trump's inauguration, and you say you believe Trump will roll back all the presidential orders of President Biden almost immediately, and regarding tariffs, that China will get them, but possibly not Mexico or Canada.
Yeah, here's my own point of view. The governments of Mexico, well, Ms. Sheinbaum is a little more feisty than was Mr. Trudeau, who will be out now at this point. I think that because they're on our borders and where they go, I think they have an easier go of getting a 25% tariff reduced in most items than China. China has, as I see it, no chance of not getting another 10% tariff on top of what they've got. Today, President Biden let it be known that AMD and NVIDIA new rules are going to come out to further limit people that act as intermediaries. That's the word that's being used for China. The countries that do so will see restrictions put on them from getting the chips of this AI. So as we look at all this, Trump is going to do what he said. He's going to come in on the presidential orders that he doesn't like that Biden has put into place, especially the latest ones. He'll reduce those. That you can do without an act of Congress. He can't just go and change everything. It requires a check and balance. Too much of it's in Congress. And Congress in the United States, thank God, is very tight. No one person can control it. So you can expect a lot of arguments, but where there is consensus, heavy consensus, is immigration. And I don't know that that's a good thing, because we have counted in the U.S. on immigration to fill the labor roles. Now, if you take out what they determine to be unwanted immigrants, I don't know if that's criminals, people here that don't have the right papers, we're going to find out. That'll be a big problem. I live in Chicago, which is ground zero for what the new government's going to do, and I'll keep you up on it here. We don't know, but it's right around the corner.
Well, let's just quickly touch on China. They've initiated some new subsidies.
Mm-hmm. Okay, so what are they supposed to do? What China hasn't done. They haven't solved the property market. We know that they go in and they continue to subsidize products, businesses, that the reality is you can't produce the products for those numbers. How much money can you lose on cars? Some of the manufacturers are doing quite well. BYD is an example. Everything I've seen on their automobiles, they shine. But there's how many manufacturers of cars in China? They can't all make money just the way in America they can't all make money. We see that left and right. So as the Chinese government keeps going with the subsidies, what happens is country after country, be it Europe, one of their large trading partners, Canada, the United States, I can go on. There's a problem with that. Where they're going to try to increase more production, steel. Well, they have to have places to sell it. It's not coming to the U.S. without a heavy tariff on it. I can tell you that. And Trump will demand that Canada don't take it. And then what do you do with Mexico, which is acting as a proxy for a number of these Mexican corporations that have the Chinese backing to bring products here? I don't know that that's a good or bad thing. I haven't made up my mind on that. It depends if it's a wholly owned subsidiary, or if it's totally a partner in Mexico. We're going to find out all this. It's all going to happen in the next 30 days. It's right around the corner.
That's right, Ira, an exciting, interesting few weeks ahead. Thank you so much, Ira Epstein from Linn Associates. Now, just checking the local market, it's looking 37 points, expected to open down. SPI futures are currently 37 points. That does it for this edition of The Global View. Stick around, The Open is coming up next.